On June 1st, 2026, Anthropic filed a confidential S-1 with the Securities and Exchange Commission. If you know what that sentence means, you already understand why this matters. If you do not, here's the translation. The company that makes Claude, one of the most widely used AI systems in the world, just took the formal first step toward becoming a publicly traded stock. And the valuation attached to that filing is approximately $965 billion, nearly $1 trillion. To put that number in context, it makes Anthropic, on its first potential day of public trading, more valuable than Walmart, JP Morgan Chase, and ExxonMobil combined. It would make this the largest AI IPO ever attempted, possibly one of the largest IPOs in American market history. And right now, the vast majority of people who will eventually be able to buy this stock have no clear picture of what they are actually evaluating. They know the name. They may have used the product. They have seen the headlines. But the actual business and the revenue, the structure, the risk, the pathway from private company to public ticker, most of that is not yet fully public, and most of the coverage of it is somewhere between incomplete and misleading. That is what this video is for, not to tell you whether to buy. That is your decision, and it depends on your financial situation, which I know nothing about. But to give you the complete picture of what is actually happening, the scale, the mechanics, the access pathways available right now, and the honest risk side that the enthusiasm tends to crowd out. Because the biggest financial decisions do not reward the fastest action. They reward the clearest understanding. Let's start with what Anthropic actually is, because the answer may surprise you. Anthropic was founded in 2021 by Dario Amodei and Daniela Amodei, along with several former OpenAI researchers. The original thesis was explicitly about AI safety, building frontier models with more emphasis on alignment, interpretability, and controllability than the competitive landscape was prioritizing. That thesis has not changed, but the business that has grown around it has become significantly larger and more commercially complex than most people following the AI space fully appreciate. The revenue picture here is the number that changed the entire narrative around this IPO. Anthropic's run rate revenue sat at approximately $9 billion at the end of 2025. By April 2026, the company reported that figure had risen to $30 billion. By May 2026, it reportedly crossed $47 billion. That trajectory, from $9 billion to $47 billion in approximately 5 months, is not typical software company growth. It is the kind of revenue acceleration that only happens when enterprise adoption of a technology crosses a specific threshold and becomes self-reinforcing. The primary driver of that revenue is not consumer subscriptions, though Claude has millions of individual users. The primary driver is enterprise and developer adoption. The Claude API consumed by companies building AI into their products and workflows generates usage-based revenue that scales with customer deployment. When a large enterprise integrates Claude into its customer service, its legal analysis, its coding workflow, or its data infrastructure, the monthly usage fees compound as adoption grows inside that organization. Claude Code alone, the AI coding assistant, crossed $2.5 billion in run rate revenue after becoming generally available in May 2025. A single product line in less than a year. The investor base. The investor roster around Anthropic's latest funding tells you something important about how the institutional world is evaluating this company. The February 2026 Series G, which raised $30 billion at a $380 billion valuation, was led by GIC and Coatue, with participation from Accel, BlackRock, Fidelity, General Catalyst, Goldman Sachs Alternatives, JP Morgan Chase, Lightspeed, Morgan Stanley, Sequoia, and Temasek. That is not a venture capital round. That is a sovereign wealth fund and institutional asset management round. These are not growth investors making a high-risk bet on a product. They are large conservative capital allocators making a conviction investment in what they believe is a durable business at scale. Amazon has committed up to $25 billion in investment. Google has committed up to $40 billion. Microsoft invested up to $5 billion. NVIDIA committed up to $10 billion. These are not passive strategic investments. They are deep structural bets by the largest technology companies in the world That Anthropic's models will be a foundational layer of the commercial AI infrastructure they are all building on top of. And yet the company is not profitable. Training and inference compute costs are substantial. The path to profitability is documented and tracked by the company, but it is not arrived at yet. The IPO is being built on revenue trajectory, market position, and the structural importance of what Anthropic is building, not on current earnings. That is a critical distinction for any investor evaluating this stock. Here is the structural reality of how private companies go public and why the window between now and the IPO matters more than most people realize. Anthropic has filed a confidential S1, meaning the prospectus exists but has not yet been made fully public. The SEC reviews it, the company responds to comments, and at some point the S1 is made public and the roadshow begins. The roadshow is when Anthropic executives travel to institutional investors, pension funds, sovereign wealth funds, large asset managers, and pitch the investment. Those institutions get allocated shares at the IPO price. You do not. When the stock finally begins trading on a public exchange, which based on reported timelines could happen in the fourth quarter of 2026, the price at which you can buy is whatever the opening market sets. For an IPO of this profile, that opening price is often substantially above the IPO price. The institutions that receive the allocation at $50 per share are selling to you at $70. The spread between those two prices is not a market inefficiency, it is the architecture of how IPOs work and who they are designed to benefit. And for Anthropic specifically, access before the IPO is available only through channels with high barriers. Accredited investor status, which requires either $200,000 in annual income or $1 million in net worth excluding a primary residence, is the baseline. Secondary market platforms like Forge Global, Equity Zen, and Hivi allow accredited investors to buy shares from early employees and early-stage investors who want liquidity before the IPO. These platforms require minimums that typically start at $25,000 to $50,000, and the liquidity is thin, meaning you may not be able to sell when you want to at the price you want. The spread between bid and ask can be significant. So if you are a retail investor with a Fidelity or Schwab account and a few $1,000s to invest, the direct pre-IPO path is effectively closed. What remains are the indirect pathways, and two of them are genuine. There are 3 realistic ways for a retail investor to get exposure to Anthropic: 2 before the IPO, 1 after. None of them are perfect. All of them require understanding what you are actually buying. Pathway 1. AGIX, the Crane Shares AI ETF. The Crane Shares Artificial Intelligence and Technology. ETF, ticker AGIX, is currently the only publicly listed ETF with direct ownership exposure to Anthropic. Crane Shares acquired a position in Anthropic during a fundraising round in early 2025, when the company was valued at $61.5 billion. As of May 2026, that position has appreciated approximately fourfold from its cost basis, and Anthropic represents approximately 2.91% of the fund's net assets. The caveat, and this is important, is that AGIX is not an Anthropic investment. It is an ETF that holds Anthropic as one of approximately 40 to 50 holdings alongside publicly traded AI infrastructure companies, semiconductor names, and other private companies. If you buy AGIX for Anthropic exposure, you're getting Anthropic at roughly 3% of your position, with the other 97% allocated to other names you may or may not want. The fund has an expense ratio that should be examined before purchase. And because the Anthropic position is a private holding within a public vehicle, its valuation within the fund is marked to estimated fair value, not to a live market price. These mechanics matter, and they are not prominently advertised in the coverage of this fund. AGIX also provides what Crane Shares calls layered exposure, meaning in addition to the direct Anthropic position, the fund holds Microsoft, NVIDIA, Amazon, and Alphabet, which are all major Anthropic investors with their own significant AI infrastructure stakes. Whether that layered structure is appealing or redundant depends on what else you hold. Pathway 2. The ecosystem plays. The second pathway is owning the public companies that have the deepest financial relationships with Anthropic. Amazon is Anthropic's primary cloud partner. The company runs Claude on AWS Bedrock and has committed up to $25 billion in investment. When enterprise customers deploy Claude at scale, they are frequently doing so through Amazon's infrastructure. Amazon's financial relationship with Anthropic is not a passive investment. It is a structural commercial relationship that generates revenue for Amazon, whether or not the IPO ever happens. Alphabet through Google is both a direct investor and the provider of compute infrastructure through Google Cloud, with commitments up to $40 billion. Alphabet owns competitive AI systems through Gemini, but has also bet heavily on Anthropic as a hedge and a platform. NVIDIA's hardware, the GPUs that power Claude's training and inference, means that every unit of Anthropic's revenue growth drives demand for NVIDIA's products. Microsoft has integrated Claude into its enterprise product stack through a $5 billion investment commitment. None of these companies are Anthropic investments. Each of them is a complex, diversified business where Anthropic represents one strategic element among many. But they are the companies with the most direct economic exposure to Anthropic's commercial success, and they are all accessible through any standard brokerage account today. If Anthropic's enterprise adoption continues accelerating, the companies processing and hosting that workload benefit directly. That is the second-order exposure available right now. Pathway 3. After the IPO. The third and most straightforward pathway requires the most patience. Once Anthropic begins trading on a public exchange, once there is a ticker symbol, any investor with a standard brokerage account can buy shares at whatever the market price is. No accreditation required. No minimum investment. The same accessibility as buying Apple or Microsoft or any other publicly traded company. If Anthropic enters major indices, which depending on market cap and listing rules it may do, then every S&P 500 and NASDAQ tracking index fund will own it automatically. If you hold a broad market index fund, you will likely own Anthropic as part of your diversified portfolio without making any active decision at all. That is probably the appropriate way for most investors to own single-stock AI exposure, as a small component of a diversified position rather than as a concentrated bet. Now let me tell you the part that tends to get crowded out by the coverage: the valuation assumption problem. A $965 billion valuation, approaching $1 trillion, on a company generating approximately $47 billion in annual run rate revenue is a revenue multiple of approximately 20 times. That is not an unusual multiple for high-growth software companies at the frontier of a technological transition, but it is a multiple that prices in a significant amount of future growth. At $1 trillion in value, the market is not pricing what Anthropic is today. It is pricing a specific version of what Anthropic will be, a version where enterprise AI adoption accelerates further, where Claude maintains or expands its competitive position against OpenAI, Gemini, and the models being developed by Amazon, Meta, and others, where compute costs decline as efficiency improves, and where the company navigates the path to profitability without a capital crisis or a competitive disruption that materially changes its market position. Each of those conditions is plausible. None of them is guaranteed. The gap between what the valuation assumes and what actually happens is the risk. And at trillion-dollar valuations, that gap can be very expensive if the assumptions prove over-optimistic. The competition is not standing still. Anthropic is not the only frontier AI company with serious resources and serious commercial momentum. OpenAI raised $110 billion at an $852 billion post-money valuation in early 2026 and serves more than 900 million weekly ChatGPT users. Google is deploying Gemini across its entire product suite and has more distribution infrastructure than any company in the world. Meta is releasing open-source frontier models at a pace that compresses the commercial value of closed model providers. Amazon is building its own models through Trainium chips and Amazon Nova alongside its investment in Anthropic. This is not a winner-take-all market. History of platform transitions suggests multiple large players survive and prosper. But it is a market where competitive position can shift with a single model release, and where the cost of staying competitive in compute, in talent, in research, is measured in billions of dollars per year. Anthropic's ability to continue matching or exceeding its competitors requires continued access to capital at significant scale. The profitability timeline. Anthropic is not profitable. The company has said the path to profitability is visible, and the trajectory of revenue growth supports it. That may be true, but investors buying at a nearly trillion-dollar valuation are buying into a company that is currently spending more than it earns. And the promise of future earnings is what the current price is based on. Trillion-dollar IPO debuts have a specific historical pattern. The opening cross often prices well above the offer range. First-day pops of 30 to 80% are common when sentiment is high. And then, over the following months and years, the market digests the actual financials as they are reported quarterly. And the gap between what was anticipated and what is delivered becomes visible. University of Florida IPO researcher Jay Ritter's decades of data show the average IPO underperforms the broad market by approximately 20% in the 3 years following its debut. Anthropic may be different. Its revenue trajectory and market position are genuinely exceptional. But exceptional is already priced in at $1 trillion. Here's the part that matters more than anything specific about Anthropic. The question of whether to invest in Anthropic, or any individual stock at any valuation, is the wrong starting question. The right question is, what is the role of a single stock position in your overall financial structure? If you do not have an emergency fund covering 3 to 6 months of essential expenses, build that first. No IPO, no investment opportunity changes that priority. If you are carrying credit card debt at 21% APR, every dollar allocated to a speculative investment while that debt exists is a dollar earning negative 21%. The IPO opportunity does not change the math on high-interest debt. If your index fund contributions are not automated and consistent, the single stock bet is putting a side wager on a company while the main game goes unplayed. But if the foundation is in place, if the emergency fund is funded, the high-interest debt is eliminated, and the automated index fund contributions are running. Then allocating a small, defined percentage of your portfolio to a single conviction investment is not reckless. It is intentional. The critical constraint is the word small. 5% of a portfolio, perhaps 10 at the upper end. An amount where being wrong is not a financial crisis, and being right is meaningful. Not a concentrated bet where the outcome of a single stock materially determines your financial future. Because here's what the data consistently shows across multiple market cycles and multiple generations of investors. The people who build serious wealth over decades are almost never the ones who nailed a single IPO at the right moment. They're the ones who stayed invested through downturns, automated their contributions, kept their fees low, and let the compounding work for 30 years without interruption. A great IPO is an event. An S&P 500 index fund held for 30 years is a plan. Both can coexist in a portfolio. Only one of them is the foundation. Here is what is actually happening in the coming months. Anthropic has filed a confidential S1. The SEC review process will take weeks to months. At some point, that S1 becomes public. And for the first time, the company's audited financials, its structure, its risk factors, and the specific terms of the offering will be available for any investor to read. That document is the one thing currently missing from every conversation about this IPO. Until it is public, every number being discussed is an estimate, a report, or a secondary source. The S1 is the primary document, and reading it when it becomes available is the minimum due diligence for any investor seriously considering a position. The window before the IPO, the window that is closing, is relevant primarily for accredited investors with access to secondary market platforms or to AGIX as a partial pre-IPO vehicle. For most retail investors, the window that matters is the post-IPO period, when the ticker exists, when the financials are public, when the first day pop has subsided and the price reflects the market's ongoing assessment of the actual reported numbers rather than the projected ones. What Anthropic is doing is genuinely important. The technology matters. The revenue trajectory is real. The institutional conviction behind it is significant. And the IPO, when it happens, will be one of the most consequential market events of this decade. But the most expensive way to participate in an important market event is to react to the headline. The least expensive way is to understand what you are evaluating before the stock becomes available, so that when the moment arrives, you're making a decision based on the numbers and your own financial structure, not based on the noise of a single day's trading. That is what this video was for. Subscribe for ongoing coverage as the S1 becomes public and the IPO timeline becomes clearer. Drop a comment below. What is your biggest question about Anthropic as a public company? I will address the most common questions directly in the follow-up video.